Theta, on the other hand, in my opinion, it measures time decay. And an important thing about Theta is it's not a linear type of thing. It's not, if an option has 15 days till expiration, it's not going to chop it up into 15 equal little parts and decay. It's actually an exponential type of curve where there are a lot of strategies that take advantage of Theta decay that aren't in the last week either, even though that's where a lot of the decay occurs. You can take advantage of Theta decay from the 90-day option to the 60-day option and never even expose yourself to gamma risk, or at least very little gamma risk.
Gamma is your acceleration, and acceleration can be positive or negative. And, acceleration gets very, very high when your options are near the stock price, so at the money and close to expiration. And gamma can go from being something you don't even care about to 100. So it's as big as it can get. And that happens short-term options.
This is going to be a very different type of a webinar discussion than the ones that some of you may have seen with various fund issuers, because in this case, this is with, let's call it an options education company with guys who I've known for a bit of time. And I think we're going to have some good back and forth around options, trading strategies, and what they do at Options Animal. For those that want to ask questions during this roughly 45, 50-minute webinar conversation, just put it in the Q&A. I'll bring it up. But we're going to make this very interactive back and forth, kind of like a live podcast with all of you fine people here. And we'll be doing these on a monthly basis, hopefully with some structured decks and going through some other things from an educational perspective. So with all that said, my name is Michael Guyette, publisher of the Lead Lag Report, and I've got my friends, Mr. Eric Hale and Greg Jensen here. I have known Eric for some time. He was actually a ex-premium subscriber, so he's paying me $4 a month, which is nice. I will say. And, but I happened to meet him.
You said X, you make it sound like former. X is formerly known as Twitter.
Formerly known as Twitter.
I'm a current premium subscriber.
You are? Okay, that's fair, right? So, which I appreciate, because it helps feed me whenever
I was like, I didn't cancel my subscription. This is fun.
No, he's still there. Exactly. And I met Eric at Camp Kotak. That's how we met in person. It's like, oh, that's kind of odd. A person that subscribes on X is at the same place I'm at. So we connected there, and then I've got to know Greg as well. He's also going to be at Camp Kotak. But for a lot of people that don't know who you guys are, you've built a nice business. You're very well versed, obviously, in the option space. So let's talk about first of all your respective backgrounds. Eric, start with you. How did you even get started in the option space?
I joined Options Animal, I don't know, like 25 years ago. I was actually a client, so and I really took to it. And then they asked me to come teach a couple classes a week. And I was fortunate that about 4 years ago, I left a full-time job. I got a background in engineering. I've held executive positions in the power industry. And, that sort of thing gives me a sort of a systems approach. And I don't know if you know this about this, but I'm dyslexic as well. I repeated first grade. I had a real hard time. I have a hard time with numbers. And, but on the other hand, I actually can see things that most people can't see. And, I have a knack for taking things that are complicated and making them simple. And, for example, I've got a really interesting, unique way of teaching the Greeks. And, I've had people tell me, I've been trading options for 10 years, 15 years. And you're spending an hour with you. I never learned so much. And now I really understand the Greeks. And so Options Animal, that's Options Animal's mission, is to take retail traders and help them, self-directed retail traders, and help them manage their accounts. So my background is like engineering. So I'm very rigorous and thorough about process and systems. But, I also have this other side where I can take complex things and make them simple.
Always the key, because when you talk about the Greeks, I think about Greek mythology. I don't think about options.
It's Greek to me, right? That's Greek. There's a way to say I don't understand. You say it's Greek to me, like I don't understand. But the Greeks are very, very simple if you know what they mean. And what it's about is when you place a trade, you want to know, how do I make money? And options are a lot different than stocks. options make money from things other than the stock price. You make money from time and volatility, risk-free interest rate, dividends, all affect the price of options. And so you've got 5 things that are moving at once, and being able to understand that can be overwhelming. So you want to try and get that as simple as possible. So that's one of the niches that we have.
For those that are here that are looking for C credits, I will email after this webinar to get your information. I'm going to submit the last 2, which I'm a little bit behind on, but that'll get done. But stay tuned to the end, and I'll make sure to get that out. Greg, you've also been around for a while.
Yeah, my background's a little unique. I grew up on a potato farm in Idaho, and my first exposure to the financial world was watching my dad use the futures market to hedge the wheat we were growing. And so I got taught an actual collar trade where I was owning the underlying asset. But I didn't want to farm. I was headed to school. I was going to go to law school. I was actually applying, preparing for the LSAT. And my dad called me up one day and said, "Hey, we had a really good year on the farm this year. We want to put some money to work in the stock market. Do you want to help me?" And like any good, grateful son, I said, "What's my cut?" Right. And we created a trading business back when I was going to school, and I fell in love and changed my major, ended up getting my degree in finance, became a registered advisor, managed money for a little bit, thought I was a genius. And what I was mistaking was a bull market for brains. I was part of the internet bubble. And it was amazing. I made so much money. I thought I was invincible, and then learned some really painful lessons, specifically with the company named JDS Uniphase. If you remember the name, one of the fiber optic build out companies, kind of how we're building out, data centers right now. I don't care if people say that it's not comparable right now. It is absolutely the same.
We're going to go there now. Huh? Okay.
Right
so that's good. No. Okay. Now it's going to get spicy. Okay. It's good. I like that.
No. So but what I saw was a lot of people getting into the options world. And I saw a lot of people taking risk they didn't understand. And so I created this company, this education company, to teach individual investors how to use options specifically in regards to their equity portfolios and how they could combine them and hedge risk. In so many cases, options get a bad name. They get pitched as this gambling addict type of tool. If you want to go and roll the dice in the market, play in the options world. And to be honest, it's not, there's nothing further from the truth in that if you use them in the way they were meant to be used. The way my dad used the options market growing wheat. The same can be done with your shares of NVIDIA or your shares of Apple or whatever it is you're trading. And so that's kind of our goal at Options Animal, is to teach the retail facing investor. And that's not to say that we haven't had hundreds of registered advisors come through our program as well, because they jump in and they're managing clients' money and they see the same risk too. They look at this bubble that we're part of and they're like, man, I got to figure out how to protect my company's or my clients' assets because I know the traditional 60-40 split is not getting the job done of, really protecting risk. And so that's kind of our mission at Options Animal, is to teach the retail trader, the retail investor, how to minimize risk and not do it by just going to cash and being afraid of the market either.
A little different than maybe some other people that are educating. We go to these like Camp Kotalk and some of these other economic events. We're very active in the Global Independence Center because we try to bring back knowledge of markets. And Greg and I spend time with Federal Reserve governors and former current CEOs and chief investment officers and economists to try and bring that knowledge back. And in those sort of forum, when I talk to people and you say, what do? We teach people education. Well, what I tell people there is we teach people how to manage risk. And nobody comes to us saying, hey, I need to manage risk. But I think everybody understands, and a lot of people understanding a sort of high level concept, what is risk? But that's the purpose of options initially, was to mitigate risk. And using options, if you use them inappropriately, you can hurt yourself. And there's a statistic every year. There's a certain number of people that kill themselves with hammers. I mean, you can kill yourself with a hammer, but if you're trying to build a house, would you say hammers are unsafe because people hurt themselves with hammers? You wouldn't say that. And so people misuse tools, misuse options. That causes problems. I mean, our typical client is a guy, or probably, I don't know, 70% of our clients, maybe 80% are men, who's a senior guy. He's somebody just like me, who's got a smart person, got a background in engineering, or he's an accountant. We get a lot of IRAs. We get a ton of doctors, ton of surgeon. They got $1 million, couple $1 million in the bank, and they get. No offense to any of your people listening, but they get somebody from one of those 2-name companies that call them on the phone. Hey, I want to manage your money. I'll give you a free steak dinner and tell you how I'm going to take from upstairs and pass down whatever they tell me to mix in your portfolio. But these people are thinking, hey, I'm smart enough, at least as smart as that person. So we educate those people, and I mean our clientele. We've had thousands and thousands of people at Options Animal who are absolutely thrilled. I mean, for me, it's life changing. It's my wife is retired. I do this, and believe me, I don't need to. I'm very happy. I'm 60 years old, and we reached a place and it was because of what we learned. And so that's one of the things that's a little bit different. Maybe is that we actually show what we're doing ourselves. I mean, I share. So I'm not an investment advisor. You can't ask your investment advisor to see their portfolio. That's because the SEC and FINRA rules don't allow you to do that, but we can. And so the proof is in the pudding, in that we put our money where our mouth is. So we have skin in the game because we're doing the same exact trades in our real money portfolios.
You talk about the risk side, because when I think about options, I'm probably thinking like a lot of younger retail, since you mentioned age, right? Senior, right? In terms of position, in terms of age, let's say older, accumulated wealth. I think a lot of people view options as the gear, right? The thing that you can just use, just lever up with a small amount of money, right, into some investment. Whereas you're saying that, well, really the proper way to use options is to hedge.
What I believe, the options story, they were created by members of the SIBO back in the 70s. And the original intent was there were a group of economists that were predicting a recession, or kind of in the middle of an inflation-driven recession. They're predicting it was going to get worse. And they said, let's use these options that have been around in the equities or the futures markets for quite some time, and let's put them in the equity markets. And they became a retail traded or retail focused. I remember when I first started trading options, you'd get the quote on the back page of the Wall Street Journal. And, they're listed in quarters and halves and teenies and all these, and then you do the math and call your broker up, on the phone, because online trading didn't exist yet. It's come a long, long way. And that's, in my opinion, made the game that much easier for retail investors, or all of the tools that you have available to you now that when I first started trading didn't exist. I mean, online trading, real-time access to quotes, commission-free trading on platforms. I mean, it is unbelievable, the tools you have and the speed at which I can level the playing field with what used to just be a game for Goldman Sachs and Morgan Stanley. And I can trade just as fast as they can, arguably faster because I'm smaller and more nimble.
Let's get into it in terms of that process of educating, because there's a lot of ways to learn something, right? I think a lot of the younger people tend to just like watching YouTube videos. Then you've got more formalized, courses, right? I mean, Merrick, maybe to you, what makes the way you guys approach things different from an education perspective?
Well, we've 8 discrete levels, so it's pretty concrete to understand. And then we've done this for, as I said, I've been teaching here for 22 years. So 24, 25 years ago is when I started, and the curriculum's evolved since then. I think we had 6 levels. Now we have 8 discrete levels that start with a very basic level. This is a stock, this is a call, this is a put, and go through some of the basics. And then we end up getting into basic spread trades. So bull puts, like a credit spread, selling and buying puts, or call spreads, iron condors, calendars, diagonals, and they get more complex, covered calls and collar trades. So the first 5 levels of our curriculum is all about strategies. Level 6 is where we got into portfolio management and position sizing, very important concepts. You understand these basic tools, these basic strategies, but level 6 is taking it and the rubber meets the road. And everything that we teach works around a 6-step process, which is pretty robust. And that I'm a person that likes to fix things. And this is a process that since I've been using it, doesn't need to be fixed. I mean, the first step is to determine the direction. So not only do we look at stock price, but we consider time and implied volatility, how that will affect. So first step is to determine direction. And the second step, we're going to consider what trades could work on that. And you're limited by your experience, by your capital, by your time available, by your time frame. All of those sort of things put you in certain trades. And then what we want to do is the third step is to select and structure a trade. So here's where we're looking at the pricing. We're looking at the max reward. We're looking at the max risk. How does the trade work? And sometimes you might find that, maybe you don't have the strikes you need. Maybe you don't have the expiration. So maybe you have to pick a different trade. And you thought you were going to do this trade. You pick another one. So this isn't 1, 2, 3, 4, 5, 6. Sometimes it's like the old rotary phone. The fourth step in our process is hands down. If there's one thing I can tell your people listening today, if you want to become a better trader, this is it. This is the secret. And that is to define what you want to accomplish. I know it sounds crazy, but if you want to go someplace, you got to know where you're at. You got to know where you want to go. So defining a primary exit. But here's where we differentiate ourselves, and that is a secondary exit. So you have this idea of what's going to happen with stock direction, which most of the time you're wrong. The fact is most people are wrong with the stock direction. That the data show that, even professionals. Time you can forecast with 100% accuracy, and most people don't understand what implied volatility is, but I think you could be about 75% accurate forecasting where volatility would go. But sometimes we're wrong. So when do you address that? You should address it before you head down the path, and that is to have a secondary exit plan. And if the trade goes against you, you have a plan on how you're going to adjust it. And when you get to the point where you are comfortable following that secondary exit, dude, you trade like a Zen master. You're calm. You're cool as a cucumber because you really don't care. If the stock does this, I'm going to go this path. This works. If it goes over here, I'm going to do something different. No big deal because you can still make money. And so that confidence, the primary and secondary exits in our fourth step. The fifth step is to place the trade. So we define how we're going to fix it before we've placed it because it may affect the trade we place. And most people, they execute a trade and it's, let's go see how do I fix this? Well, you bought a long call a month ago. It expires on Friday. It can't be fixed, right? Your max loss is your secondary exit. So that secondary exit, and this is, I don't care what kind of trading you're doing or anything you're doing, any sort of venture is to have a plan. And if you were a professional, whatever field you're in, if you were teaching somebody, if you're an expert in your field, you would teach them, hey, you need to have a backup plan. You're a pilot, right? So look at the weather and have enough fuel in case you need to land someplace else. That's what I do. That's the same sort of concept that we use. In fact, one of our instructors is a retired airline pilot for American, and he uses the airline examples. He says, and with regards to placing the trade, he says, takeoff is optional, landing is mandatory.
Before you go to step 6, let me add a little color to that. The importance of step 4, especially in the trading world. 2 specific emotions that you're controlling here are fear and greed. Equally blinding emotions when it comes to money. Greed, if you've never been in a greedy trade before, go buy calls on Palantir someday and be right in the right direction. And all of a sudden you realize, man, I've doubled my money in 3 days. And instead of, that mind, the guy in the back of your head going, you really should take that off the table. You say, let's see how far I can let this ride. And you let it ride and you let it ride. And then something bad comes around and Palantir's down 15% in a day and your trade is gone. And so even in the primary direction, set those exit points, predefined plan. It could be aggressive. You can say, I want to make 100% on this trade, but just set it before the trade. Because once you get in the trade, and you're in the game, trading is emotional, and those emotions will cause you to make mistakes.
Would add also, I think emotion is most visibly seen in volatility suppression or expansion, right? I mean, that's which relates directly to options. But yeah, anyway, continue. I think it's an interesting way of framing it.
So understanding the sentimental aspects is something we spend a lot of time. I think once people understand implied volatility, it is one of the best kept secrets that retail traders could be using to understand when a stock is going to make an explosive move. But we can show you some data. Maybe in the future, we'll show you some graphs where I've showed people this. Like you see this implied volatility line going up, 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 and then the stock explodes. And then the next earnings cycle, implied volatility going up, 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 and then the stock explodes down this time. And people are like, what is that data? I need that data. I'm amazed that traders are not looking at implied volatility. We do look at the VIX. The VIX is an implied volatility index for the S&P 500 SPX options, but individual equities have their own VIX and they behave differently than the regular VIX. And it's the sort of thing that I could, if you took it away from me, I'd probably stop trading because it's so powerful and so useful. It really does give traders an edge.
So you've got plenty of people that are signing up to, learn about options trading from both of you guys. Talk me through sort of like what a course looks like or what a series of courses looks like.
There are 48 classes. Typically, an average class is about an hour. Unless Eric teaches it, then it ends up being a couple of hours. They're all so we've broken it into levels so that you can take it in chunks and build upon one another. And there's a test at every level to get you, to make sure you get something before you move to the next concept. The courses are all online. It's all archived. You can fast forward, rewind. There are 7 different instructors from all different walks of life. Some of the students may relate with Eric as an example. They might have an engineering background, might like things really analytical. They might relate with another instructor, and that you have the capacity to pick and choose where you want to go. But yeah, it's all learn at your own pace. We've had some people, in fact, I actually spoke with one of our students who got a relatively large portfolio that he manages, 9 figures portfolio. You'll actually get to meet him at Camp Kotop.
It's a nice student to know.
He'll be up there. He's a fascinating gentleman. But he told me when he joined our program, he rifled through the education in a matter of about 30 days. Just ripped through it, and then started trading and realized I went too fast. I got to go back. And then he went back through. And so we usually sell it on a time basis. It's not a one-time through. You can take a class 50 times if you need to. Most people get it the first time, or again, because you can do it on your own pace. Maybe you don't have 24 hours a day to give to it. You only have 2 hours a day or 2 hours a week even. You've got the capacity to do that and take it at your own pace.
Tell me about the collar, Greg, from...
Collar is my bread and butter. It is a trade. And again, it came about through JDS Uniphase. I thought I invented the trade. I didn't know it actually existed and had a real name. But, I was trading JDS Uniphase and I first bought the stock at around 400. I shouldn't say that's the first time. This specific time that taught me the painful lesson. I bought the shares at 400, sold a covered call on it. The stock proceeded to go from 400 to 2. Not 200, 2. Yeah, I mean, it just absolutely, plummeted. But I started toying around with options. And so I thought, what if I had a put here? All of a sudden, the stock my portfolio, even though the stock was still going down, my portfolio wasn't going down anymore. And then I thought, what if I tweak the call? What if I roll the call here to pay for the put so the put doesn't cost me any money? And all of a sudden, I'm in a trade for a credit. I'm lowering my cost basis in these shares, and I'm protected to the downside. I don't care if it does go to 0. Maybe 0 I would care, because then I have the whole issue of delisting and that whole mess that I actually have to exercise my options. That may get fun, but the stock get absolutely crushed, and I don't have to worry about the value of my portfolio. In fact, in some cases, when you get really volatile outside moves to the downside, your collar actually, even though you've got a long equity position as part of it, you actually can end up being delta negative and make money when the stock goes down, even though you're positioned with a long-term bullish equity. And that's what all of a sudden opened my eyes. It's like, I don't have to fear that, NVIDIA is too pricey right here. It's had too big of a run. There's no way it's worth $4 trillion. I got to step back and I can't trade this thing, and I got to go to cash. And then I watch it go from 4 trillion to 5 trillion, right? That's what typically, and then you chase it. Your emotion says, oh, I missed it, but it's still NVIDIA. I got to get in. And then it goes from 5 trillion to 3 trillion in market cap. And now you're behind the 8 ball. The collar allows me to stay invested, use the options tools to hedge risk. I kind of view it as the equity is this kind of like your nest egg, and it's there. It's your beehive, your honey. And the options instruments are worker bees around it. I can use them to hedge off risk and hedge off downward moves. I can use them to bring in cash flow, to lower my cost basis. And so it's an actively managed type of trade. But I don't have to fear the big move that everyone knows is coming.
I wanted to throw on a little bit about that collar, is that it's sort of like, do you play poker, by the way? Do I see it at the poker table in Camp Kotak?
I mean, I was observing. I was still, I don't have that much free liquidity. Right?
Okay. So liquidity, I know you got young kids and you're a wise man, and that's probably a good thing, not gambling. I think my probably respect goes up. You've heard this about Texas Hold'em. It takes a minute to learn, a lifetime to master. And the collar trade is a very simple trade. It's long stock. It's a short call, which that's a covered call, and then a protected put. So you add a long put to it. So there's really 3 components to it. And, that sounds pretty straightforward. But if you think about just sort of a general framework of, you can have a covered call that's in the money, at the money, or out of the money. And then you could have it short-term, intermediate, or long-term. So that would be a 3x3 matrix. So there's really 9 different covered calls. And maybe we could say you don't have the stock. So that's 10. And puts are the same thing. You could have a short-term put, a long-term intermediate put, or you can have it in, at, or out of the money. And they all behave a little bit differently when you pair them up with stock. So there's 10 of those. So if you take the 10 combinations of how you can do a put, 10 combinations, that's 100 different collar trades. And each one of the collar trades is different. And I meet people say, oh yeah, I understand the collar trade. And so we'd sit down and talk. Maybe you don't actually understand the collar trade, because Greg threw this out, and I don't know if you picked it up. You can actually make money with the stock going down. So you can have a bearish collar trade where you own shares. So you've got your nest egg, you got your portfolio, stock's dropping, you're making money. You can have it so that you make money in a stagnant trend. You can have it and it makes money in either trend. Over earnings. This is a fantastic structure. We do this all the time and show it in our portfolios. I own Apple. Apple's coming up. Apple normally goes up. So I'm going to structure a collar trade that makes money. And I can quickly show you, if the stock goes this way, I make money. Stock goes this way, I make money. As long as it doesn't stay in the middle, which a lot of time that's what's going to happen over earnings. And if it is stagnant, we have a plan for how we adjust it that way too. So we tend to attract a lot of people who have, already built a nest egg, and they've already got capital, and they want to try and either generate some income or protect their assets or gain some leverage. Using the collar trade, they can do that with the existing portfolio they have.
We talked about X, formerly known as Twitter. As I'm sure you've seen, as I've seen, there's always some anonymous account that shows a screenshot of some out of the money call option that they crushed it on, and they made millions of dollars. And you never really know if this stuff is real or not, right? I tend to be skeptical, right? They show you the winners, not the losers. But let's talk about cumulative performance. Talk me through, for each of you, given your knowledge set, given how you approach the options side of things, what type of returns have you guys had?
We can talk about this because we're not registered. But I share an account where consistently over the past 3 years, I've generated 30% a year. And the good thing about that is it's all been with managing risk, and I've had less volatility. So if we did a Sharpe ratio on it, I have less or Garch analysis, less volatility than the market because I'm hedged. The trades that we share in our portfolio, so people, we have different levels of membership, and one group of people get a trade idea every month. Some people get trade ideas every week. Those trades are 92% of the trades we're closing for a profit, and that's a demonstration of the adjustment plan. Now the return, Greg, you know what the return is on those trades? It's 16%.
Yeah.
Is it? That's not annualized. It's just 16%.
No, that's an average return on the like 700 and some trades that we've
16%. And what duration? The average duration of the trade is.
I think the annualized percentage is like 95%. It's something ridiculous.
Yeah, so it's I think it's
not on a
6 weeks is the average duration of those trades.
Which really is interesting because again, when I think about options, all I think about is zero DTE and all the kind of very short term type of things.
Yeah, well, and that's where, again, what a lot of people focus on in today's world is they focus on gamma, they focus on theta risk, and they're always looking at very, very short-term trades. And in my opinion, that's not the reason options were created. Can you make money with it? Absolutely. You can crush it. But I can make money throwing on the roulette table too. And they're going to give free drinks. It's... in my opinion, 0-day options, the only benefit to me that I see from it is it's given me more liquidity as a trader because there's more people in the game. But I think most options traders have no idea the amount of risk they take when they're trying to trade like a market maker does, trading like a floor trader. That's a completely different world than what most average individual retail investors, number one, have the passion for, or the time to do, or the capital behind them, that if they're wrong in the short term, they don't just absolutely obliterate their account. So to me, I'm a much longer term type of trader. I like trades that are 3 months long, 6 months long, and I target a 10% return in 3 months. Because if I do that 4 times a year, I'm 40% return on my portfolio. I mean, that beats Warren Buffett.
You mentioned gamma and theta. There's a question about evaluating the trade-off between the two. First of all, for those that are not as well versed, let's define those two, gamma and theta, and why is there a trade-off?
Gamma is how fast an option price moves relative to its delta, relative to the underlying asset in the movement. And obviously, high gamma reflects usually very short-term trades. Gamma is something that it can be really ugly really fast. I don't, how they chose gamma as that one, I'm not sure. I always view it, it's the Incredible Hulk story. You can go from Bruce Banner to Incredible Hulk really fast. And it's usually something angry that's causing it. Theta, on the other hand, in my opinion, it measures time decay. And an important thing about theta is it's not a linear type of thing. It's not, if an option has 15 days till expiration, it's not going to chop it up into 15 equal little parts and decay. It's actually an exponential type of curve where there are a lot of strategies that take advantage of theta decay that aren't in the last week either, even though that's where a lot of the decay occurs. You can take advantage of theta decay from the 90-day option to the 60-day option and never even expose yourself to gamma risk, or at least very little gamma risk, and still take advantage of theta decay over that curve. And there's some really good trades that you can do that. So, Eric, you want to add more color on that? Eric's got this amazing class he teaches. He kind of insinuated to it. It's a 3-dimensional Greeks class that he teaches, and it's
using visuals.
It's amazing.
Yeah. So I show you right now I'm, you ever hear there's a joke about how do you get an Italian not to talk and make him sit on his hands? I can't show you right now. I want to show you a graph. I can draw some pictures. I could, pull up some charts and show you, and that's how I can explain. But gamma, think of physics. Delta is your speed. Gamma is your acceleration. And acceleration can be positive or negative. And, acceleration gets very, very high when your options are near the stock price, so at the money, and close to expiration. And gamma can go from being something you don't even care about to 100. So it's as big as it can get. And that happens short-term options. Now, the question asked with theta, when you're negative gamma, you almost always do that. It's a simple, if you look at your portfolio, look at a trade, say it's negative gamma. It means you do not want the stock moving. It means things are going to change in a big direction. So an iron condor, for example, is a negative gamma trade, but it's theta positive. So if you're almost always, when you're negative gamma, you're positive theta. And that means you want the stock to be stagnant. So you're going to make money with time. And if you're trying to maximize that, like I want a lot of theta decay, you need to be using short-term options that are near the money. And the trade-off is that your gamma is very high. So if the stock moves even a little bit, your whole trade goes out the window. So so we talked about theta decay, and I mentioned this earlier. There's a time component that's on here, that your time, how much time do you have to manage the trade? You mentioned DTE trades. People who trade DTEs, they have a hard time getting up and going to the bathroom. I mean, you're especially towards the end of the day, that theta and gamma is really kicking in, and you watch it. If you're trading any of these options, the last few moments, the last few hours of the day, the stock's moving in the morning, the stock's moving like this, and your trade's moving like this. At the end of the day, stock's moving like this, but your trade's going up and down like this. And that's the impact of gamma towards the end of the day. It can really whipsaw you out of there. Quite frankly, it's not my style of trading. I like on Fridays, expiration Fridays, I'm wrapping up most of my trades. I've already, if I have anything expiring that day, that means I don't care if I get assigned or exercised. I usually am closing those options. Now, these gamma junkie, theta junkie people that are trading 0-day options, I think it's interesting, but I want you to know that we've got such a large audience. We've got tens of thousands of clients. And what sticks out of my mind when we think about 0-day options is the people who call us panicking. One guy tried a small trade, tried following an adjustment. The initial trade at $10,000 risk. The next trade that he did put him in a situation because he rolled the trade. It's a common adjustment strategy people do, but he had to take on more risk. Now the guy's looking at losing $30,000 in his 401k. That's more money than he puts in his 401k in a year. That's, here's a guy who's in tears, and that's not the only example. One of our clients was telling me that his mother was trading short calls. Do you know this guy, the guy who wrote the Option Selling Strategies book? Do you know the story about this guy?
Yeah, no, what's up?
Oh, this guy he was managing people's money, and what he was doing was selling naked calls on natural gas futures. And he was making 20-25% a year, taking people's money. And this guy is one of our clients. His mom put $1 million with a guy. And he said, Mom, what's the strategy? Naked calls on natural gas. I can see the book right there. And his name is on the top. Cordier. There's a video of him crying because he blew up $250 million of his client's money overnight because natural gas went from 2 to 12. And so those sort of strategies, there's people who trade for more reasons than making money, Michael. Some people, unfortunately, have other motives, which are, and there's an addiction here. Maybe it's gambling. And, there's room for that. Greg and I both like to gamble. If we're in Vegas, you're going to find us in the craps table, and we'll be playing poker with you or with other people up in Camp Kotok. But
I'll teach you the collar trade on the craps table.
Okay. Yeah,
it's really boring, guys. Especially, it's really boring, but you can sit and drink all night long if you want.
Well, yeah, I'd have to do when I'm not fasting, obviously. So it's I'll have to plan that a few weeks in advance. There's another question here. It seems all the platforms and educators just talk about short options and time decay as the preferred method. What about the case for good old fashioned going long options?
I always come back to whatever the risk is that I'm taking. And I'm comfortable with it. And I have, like Eric mentioned before, those primary and secondary exits planned. Absolutely. You can, some of my best trades in the last few years have been absolutely straight long options. I had long puts just before I bought them last July, right before Japan. Last August, and absolutely crushed it with just straight old long puts on the SPY.
Because he knew that we were effed.
Because I knew, because I was following you. No.
I was going to say, you're welcome.
It's coming.
You're welcome.
Yes, thank you. Thank you.
I kept seeing pictures of Godzilla on Twitter. I didn't know what it meant.
What's the one of the
Doctor Strange.
yeah Doctor
There's
Strange?
only one outcome. That's the most annoying one. I've been doing that like every day, for the last 2 years.
But Japan's blowing up. So the question, long options.
I like how you just said that like under your brother. Oh, Japan's back on track now.
Well, I love it, man. You definitely get a lot of attention, which is interesting. Right now I'm looking at my bookshelf, and, Nassim Taleb and Mark Spitznagel have universal investments, which is when you think of long options, those are the guys that are doing it. But those guys go 2 or 3 years without making money. If you trade long options, there is a strategy that works. You've got to be uber patient, and you do have to be smart and pick the right equities. And those guys, when we get a drop, all of a sudden, Spitznagel's up 4,000%. Everybody's wants to follow him. Then you follow him for the next 2 or 3 years, and you're going to lose money. And I know prop traders who've done the same thing. The reason most educators focus on theta positive credit spreads is the probability. It's a high probability trade. If you just the sheer matter of probabilities. If you're buying a long option, there's a high probability you're going to lose money. And so that's, for me, it's sticking with probabilities. And this goes to Bayesian adjusting. So when you think about the Bayes theorem, and that is taking whatever new data you have and being able to adjust whatever the situation is now. We have an instructor who says, where's the opportunity now? And if you plan your trade ahead of time, you can start with a high probability trade, and then it's going against you. So you adjust to another high probability trade. And if you planned it out right, your next trade could be high probability. That's how insurance companies and casinos make money. And you don't get explosive returns, although you can have explosive trades that are theta positive if you combine options. There's a trade I call the option unicorn, where you've got moderate risk, high probability, and high unlimited return. So this is where basically you're using a credit spread to pay for the long options, so you can still benefit from that explosive move. Now, if it's stagnant, you make slightly less money, but you've got good risk protection. I do these sort of trades a lot, and they pay off pretty well.
When you're trading options for each individual, are you doing it on individual stock positions or on broad averages? Because you get very different results, right?
Right now I've got positions in individual stocks, but I also have a position on the SPY. So now I do prefer ETFs. I don't venture into the cash market, the futures market, mostly because that's my background. I started as a stock guy, and when ETFs were created, it's like, oh, good, I can stay in the stock world, and because your options act a little bit differently. But we have students who do them all. They do cash positions on the SPX options as well. But yeah, I would say the answer is both. I prefer individual stocks versus ETFs and broad indexes, mostly because you get bigger moves. You have that can increase risk if you're wrong, but as long as you understand your exposure and your adjustment process of how to fix that trade, you can make a lot more money trading NVIDIA and Palantir than you can trading the Qs.
There's also slippage in ETFs, and liquidity is an important factor that everybody will learn the lesson on poor liquidity. Poor liquidity is how easily something trades. If you look at the bid-ask spreads, and the wider the bid-ask spread, and that's how the market maker makes money. If there's lots of volume, they'll make it up on volume. But if you've got something that's not traded very well, and a lot of the ETFs aren't traded as well as far as the options go, so you've got slippage in the ETF because there's fees in the ETF, and then you've got bid-ask spread. So I personally don't trade a lot of ETFs. I'm okay. They tend to be dampened too, if as opposed to trading in NVIDIA or I'm looking at Amazon, Berkshire Hathaway, Dell, Freeport McMoran, First Solar, Interactive Brokers, NextEra, Nike, NVIDIA, and Schwab right now are the positions that I'm holding in this account. And so I don't have any ETFs. But each one of these is a trade that's doing really well.
Talk to me about the live sessions. Like, what do actually people see? Like, you're sharing your screen presumably, but like, what's happening during these sessions?
Often, it depends on what kind of live session it is. So some of them are classes, so it's going to be more structured type of setting where an instructor's got a PowerPoint. They're going to go through and teach a concept. Maybe it's about delta. and maybe it's about the Greeks, and there'll be a whole PowerPoint presentation built out. And you can ask questions via the webinar the same way you would in this one, and the instructor will take time to sit and answer questions. So there's that. But then we also have every day we have a session called the Daily Market Update. About 30 minutes. It's at 5 p.m. Eastern time, 30 minutes to an hour, depending on how busy the day was, but just kind of a summary. And it's a live session every day. Here's what happened in the market this week. Here's important things to look at tomorrow. And then we also have what we call these open forum sessions, where it's kind of more like I always bring everything back to your college education, right? We've tried to structure our school like that, Options Animal, in that, I remember when I was going to school and getting my degree, you'd go to your professor's lecture, and hopefully you'd remember 25% of the lecture if you were good at taking notes. But the real learning happened for me anyway in the TA sessions, the little review sessions that it was a senior in college. He was teaching the class as a teaching assistant, and that's where the real learning took place. And so we have similar sessions built where it's just we call them live open forums, where, hey, you want to talk about a specific question you have, they can bring those to those live open forums. And so we try to make the learning as interactive as possible so you can ask questions. And then again, those sessions usually happen daily.
And we divide those in half. So the first half is a beginner one so that newbies don't feel overwhelmed. They can ask basic questions. And I know when I started, I went to these sessions, and I joke that I didn't even understand the question people were asking. People were asking questions, and I'm like, I don't understand what that question means. Never mind the answer to the question. So I was really overwhelmed. I felt like I was watching a train go by and wondering, when do I grab on this thing? I'm going to get hurt. So we toned it back, and we start each one of those sessions. So the first 30 minutes is let's keep it basic, and newbies, you can come in and ask questions. There's no dumb questions. Greg mentioned the daily live market recaps. So one instructor does every day, but on Fridays, 3 instructors get together and we review the whole week. And then not only that, but we talk about what we're trading. And that's, we know what people watch more than anything else. It's the last 10 minutes of that session. Some people just fast forward because the last 10 minutes, each of us go through 3 trade ideas that we're talking about. Now, Greg mentioned, or I mentioned earlier, we do have a website where we post live trades. So I got filled on a trade. Actually, NextEra is the trade that I just did this week. Or was it last week? Last week. And so, and there's a healthy conversation going on back and forth. Like, what about this? What about that? So, those are on the websites, and we could talk about those in the live sessions as well too. But we tend to have that communication on the website, just through forums.
So for those that are here that want to maybe attend one of these live sessions or just learn more, talk us through how do they do that?
The easiest way would be to just go to our company's website. Go to optionsanimal.com. On there, you'll have one of the links will be, learn more. It's actually right in the very center of the page of these beginner and advanced option webinars. There's a free class that you can sign up for there, no cost. And we kind of walk through, similar to some of the conversations we've had today, but a little more focused on what our education does for people. That's probably the best way, I would say, for people to find out information. We had, if you want to, we have enrollment directors as well, who are willing to pick the phone up. So if you'd rather talk to someone than take a free class, we have a phone number there as well, also listed on our webpage.
888-297-9165.
And there is a code, I believe.
We'll offer, if people call and they mention lead lag, we will make a special offer for those folks. Yeah.
That's my prompt. So exactly.
Yes. So people do call. I should mention one other thing. So we're wrapping things up, and you might see this logo behind me that says Trader Oasis. And we'll talk about this later. But one of the things that our retail traders really asked us is, where should I trade? And so we've created a trading platform. We offer a flat fee, commission-free program for retail traders. And we've got a platform which is specially designed for option traders. We mentioned, cost basis tracking. That's one of the features of the software. So I spend most of my time, I part-time teach over there. I spend most of my time at Trader Oasis. Greg spends some time over here, but he spends most of his time over on Options Animal. And the OA in Oasis is Options Animal. So these two organizations go hand in hand. We'll talk more about that later.
We're doing a lot of these in the months ahead, folks. Please learn more about Trader Oasis and, of course, Options Animal. And I will send an email again for those who want to see credits. And hopefully you all enjoyed this conversation. We're going to switch it up every single time. So we'll keep it intriguing with some trade ideas and talk about markets. So we'll get dynamic. But appreciate everybody that's here. Appreciate Greg. Appreciate Eric. I'll see you guys at Camp Kotak.
Thank you. Thanks, Mike.
Thanks, man. We'll see you.
Thank you, everybody. Cheers.